Hi, my name is Darren Osborne. I'm the Director of Economic Research for the Ontario Veterinary Medical Association. I'm joined with Jordan Morelli and Dr. Chris Doherty. We're going to talk to you today about selling your practice to corporate. Gentlemen, would you like to introduce yourselves?
Sure, I'll go ahead. Yeah, my name is Dr. Chris Doherty. I work as an economic analyst with the Ontario Veterinary Medical Association.
Hi, everyone. Darren, thanks, and Chris, thanks for having me. My name is Jordan Morelli. I'm a lawyer at the law firm of Dale Lessman. I'm counsel to the Ontario Veterinary Medical Association and also very experienced with these types of transactions. So happy to be here. Thanks for having me.
So I put the date on here. We're recording this June 1st, 2021. And the reason I put the date on here is because things are changing very rapidly. So if anybody's going to reference this down the road, the number of corporations, the rules regarding it, and the trends are changing. So we're presenting to you the most up-to-date information we have available to us at this point in time, June 1st, 2021. So I'm going to start by introducing the players in Ontario specifically. This is going to be an Ontario-centric presentation. So in Ontario, there's a small number of larger corporate players. The first to enter the market was VCA, but the largest by a long shot is Vet Strategy. Vet Strategy, has 230 hospitals across Canada, and at last count had 70 hospitals in Ontario, 70 corporately owned hospitals. VCA, the first to come into Ontario, has 100 hospitals across the province, and we'll get into the specific details on how many are in the province. The next player is National Veterinary Associates, which is one of the largest players in the United States, and right now, third largest in Ontario. We've also got P3, which is a corporation that has only been around for a few years, but are making very quick strides and are rapidly growing their number of hospitals in Ontario. And we have VetCare, a outfit out of Western Canada that has moved into Ontario in the last couple of years. So those are the key players. And when we look at the what kind of share these people have in Ontario, when we look at the number of active practices, I've got data here starting from February 2020. Then we fast forwarded a year, and you can see that there's been some very rapid changes from February 2020 to May 2020. The number of active practices in the province has not changed significantly, but the number of corporate practices has grown considerably. So February 2020, we had 99. It grew to 136 in February 2021, a year later. And in a couple of short months, that has grown by 30 practices. So we're right now at 166. The largest player in Ontario is Vet Strategy with 70 hospitals, followed by VCA at 50. Then we've got NVA at 22, P3 at 11, VetCare at 12. So right now, the market, when we look at the number of veterinary hospitals that are corporately owned in Ontario, we're at 10%. One of the things to consider is that the corporate practices generally buy larger hospitals. So the hospitals that they control are multi-vet practices. So when we look at the revenue that is controlled by corporate practices, it's significantly higher than 10%, probably in the neighborhood of 20%. So some of the consolidation trends that we've seen or that we're expecting, and chime in here, guys, with your opinions. But right now we're seeing 10% of hospitals corporately owned, 25% of revenues. Larger hospitals are owned by corporate. Most of the larger practices are already corporate owned. So I see the corporations are starting to set their sights on smaller practices. And one of the things that is happening right now in other countries is corporate has pretty well bought up everything. So right now they are in the process of owning most of the specialty practices. And in the UK, for example, they're starting to buy up very small hospitals with the intention of funneling into specialty practices. So if that trend comes into Canada, comes into Ontario, then we could look at control of 50% of the market.
When you say 50% of the market, are you saying 50% of the revenue or 50% of the volume of clinics?
That's a very good question. I think that they could own as many as 50% of the volume of clinics.
Okay. Do you know, this might be a question for the AVMA, but what it is in the United States?
It's very similar to here. Now, in contrast, I did some research into other trends. And Jordan, I know you've got some experience in pharmacy. In dentistry, it's a very small amount. Corporate controls 4 to 6% in dentistry, and that has not really changed over the last number of decades. And the people I talk to in the dental industry have said that corporate has always had a very difficult time making money in dentistry. But then in pharmacy, we've got, what would it be, Jordan? More than 50% of pharmacies would be corporately owned?
Good question, Darren. I don't have the specific numbers, but certainly the roll up, for lack of a better term, is very mature in pharmacy, and the multiples are much lower than what we see in veterinary medicine. We have in pharmacy, there are very active consolidators such as Shoppers or Rexall or McKesson, for example, and it's a large part of the market. Veterinary medicine is really, I think, one of the last medical industries as a whole to see this type of roll up. It's actually, in my mind, from a very layperson's point of view, it's pretty far behind a number of other industries. So I think we can expect to see it catch up fairly quickly.
So what do you think is, what would be the control of the market that corporate would have in veterinary medicine?
What can we expect to see?
Yeah.
Yeah, that's a good question, Darren. I know in working in other industries, such as insurance, in the insurance brokerage business, I seem to recall that about 50% of the brokerages were owned by corporate. So that sort of 50% threshold seems like a common number. You mentioned it earlier. I don't know for sure. I've never looked at these types of numbers in the past. There will always be a place for the independent veterinary hospital. And it sort of just depends on the market. As you said, the corporate consolidators do not want to, at this time, purchase maybe some of the smaller practices. And in the future, there will always be a place for the independent hospital. Maybe it's too remote. Maybe it's the practice is still too small in the future. Perhaps just even a place for a veterinarian to provide better care or certain services that corporate might just not be as experienced in. So I've never looked at the number, but 50% seems reasonable.
Okay. So when we look at how much a veterinary practice is worth, one of the things that is changed rapidly is the perspective of the purchaser. In the old days, it used to be a veterinarian who looked at buying a practice as buying a job. And when a corporation looks at the veterinary hospital, they look at it as an investment. So these completely different perspectives create different expectations of value. And we're going to explore that. So with a veterinarian, when they're purchasing a job, they ask themselves the question, would I be better off purchasing a practice, or would I be better off as an associate? And in a lot of cases, in fact, in almost every case, a veterinarian would be better off as a practice owner than they would be as an associate. But then when you're looking at the value of a practice, so they've made the decision to purchase the practice, but then they look at the cost of purchasing the practice. And then there's the question, would I be better off if I just started up on my own? And this is one of the things that is really that second question is becoming a lot more prevalent with these huge multiples that corporations are paying. So you've got somebody who is looking at a 15 times multiple of profit. So that means, and we're going to get into the specifics of this later, but let's say it's going to take 10 years, best case scenario, to pay off that corporate practice, or sorry, that corporately priced practice. In a lot of cases, they would say to themselves, I'm better off starting up a practice on my own, because in 10 years, I'm going to be farther ahead than versus buying a practice that is, say, corporate priced, and it takes 10 years to pay off. Now, contrast that with a corporation. They don't have the opportunity to start up their own practice because the corporation is not veterinarians, it's shareholders. So the corporation is looking at this purely as a return on investment. So the question they're asking themselves is, will I be better off in veterinary medicine than what I could in the market, any other market? And are there alternatives? And for them, for a corporation right now, because a veterinarian has to own the practice, it's very, very difficult for a corporation to start up a veterinary hospital. So they don't have as many alternatives. So the corporations look at it differently. They want a return on their investment. And if they want to enter veterinary medicine, they have to buy a practice. They can't start one up on their own, or at least they haven't up until now. So from a veterinary perspective, you've got a practice. Let's take a practice that has revenue of $1 million and has profit of $150,000. And this is what we'll see in the typical veterinary practice. Now, when I say profit, that's after you've paid all the veterinarians. So the owner pays themselves a fair market wage. And after everybody is paid, there's $150,000 profit left over. So in the olden days, when a veterinarian wanted to purchase a practice, a veterinarian would go to a bank, and the bank would give that veterinarian a maximum of 5 times profit. Now, I did a literature search on where the 5 times came from, and nobody really knows. But right now, the banks, and this has been like this forever, the maximum that a bank will lend a veterinarian who gets amazing preferential treatment, but the most they'll lend is 5 times profit. So that led to a maximum valuation of 5 times. And that was up until corporate stepped onto the landscape. That was the most anybody would ever offer a practice for sale, was 5 times profit, because it was impossible for anybody to get more than 5 times. So that was always the holy grail. If you could sell your practice for 5 times profit, then you were a huge success. So the value of the practice to a veterinarian, if you're buying the practice, let's say you're paying 5 times for the practice, $750,000. You want to be able to pay yourself as a veterinarian. And there's, so in this fictitious example where you've got revenue of $1 million, profit of $150,000, you buy the practice, you pay yourself as a veterinarian, you have $150,000 left over. That's the money that you pay the bank every year for 5 years. So simplifying this, assuming that there's no interest, you have $150,000 every year to pay the bank. Within 5 years, it's paid off. And as the practice grows, it becomes more profitable. So you would benefit slowly as you can increase the profits by more than $150,000. But from a veterinary perspective, it was always, I pay at most 5 times. I pay off the practice in 5 years. After that, I get my salary plus, in this case, $150,000 profit.
Yeah, Darren,
Yep.
just to fill in there, I think the 5 times multiple, and again, I'm a lawyer and not an accountant or a banker, but the 5 times multiple is pretty common across a number of industries, especially in the medical profession. Certainly is common in pharmacy. So that it may just come from somewhere else. Its origins may just be from another industry that's not specific to veterinary medicine. And then you mentioned, and then corporate came in. When I was starting to do transactions in the veterinary industry, about a decade ago, I seem to recall that the business brokers, a number of them came over from dentistry and sort of started trading in veterinary clinics. And there was a lot of, amongst the professionals, there was a lot of surprise because the value started to go up. So it did creep up. I didn't do I didn't backwards, sort of do the envelope math, but it did creep up maybe to 6 or 7 times in certain instances for a well-valued practice. Certainly nowhere where we see now. So in my mind, it was almost, associate to owner transaction was 5 times, as you mentioned. Then in certain instances, the practices were brokered, and often they'd actually ask for more money, or at least in some of the transactions I was involved in. And then corporate got involved, as you said. And then when they first sort of got involved, in my mind at least, the multiples were still pretty reasonable and nowhere near what we're seeing today. But I won't skip ahead too far.
And you're right on that, Jordan, because I recall that same era. And I remember the questioning a broker about that. And I said, how can you value a practice more than 5 times if the maximum a bank will give them is 5 times? And their response is, it's worth more than 5 times. If you can pay it off in 7 years, that's a fair deal in their mind. And when you think about it from a purely business perspective, and this is the one of the reasons that there was such an opportunity for corporate, is the 5 times is, from looking at it from the perspective of an investment, that's equivalent to about a 20% return. If you can buy a business that's for $750,000, it's going to generate $150,000 a year. That is an amazing opportunity. And I think that was the gap that the brokers saw first. And they said, well, we can go up to 7 times. And people were finding the money to come up with the practices because it's still a good deal. And then corporate took that even farther. So let's see how far corporate took it. So we've got the revenue of, I just went through this. So $1 million revenue, $150,000 profit. So the $750,000 value at 5 times is a 20% return, that was the standard for healthcare professionals, veterinarians in this case. But from a corporate perspective, the benchmark rate of return in the market is 7%. So a 7% return on investment changes everything. So if you have a corporation coming in looking at the same deal, they will say to their shareholders, we can pay up to $2.14 million on this business because that will give you shareholders a 7% return. And that was the big difference in values, was corporates looking at a veterinary hospital not as a buying yourself a job and being limited by that 5 times profit restriction that the bank put in there to protect the veterinarian. That's what the bank's limited at 5. The corporate investor is willing to pay $2.14 million for the same practice.
Darren, and I don't want to get too in the weeds here on valuation and macroeconomics, but I think, in my opinion, I think a part of it too has been the long run decrease in interest rates, right? Because, you talk about how that return 5 times is equivalent to 20%. I mean, that's predicated on back in the day, a risk-free 5 or 10-year government of Canada bond, what was it paying? 5, 6, 8%. That same bond is paying what today? 1%, right? Yeah. So I guess I would probably propose that a portion of the increase in value is the fact that, you can't get 5, 6, 7% on a government bond anymore. You can get 1%. So it pulls that rate of return down, which you and I have talked about how that mathematically flows through to the multiples that are on practices.
So, and that's because of is it because they have lower expectations on the return, so it increases the amount they're willing to pay?
Well, it's what you talked about before, right? It's the alternatives. So like let's say I could buy a government of Canada bond that pays 7% per year. Why would I ever buy a veterinary practice that gives me a 7% return? There's so much more risk in a small veterinary practice when I can essentially have, I would call it risk-free return of 7%. That goes away when the risk-free rate is 1% or 1.5% or whatever it is today, right? Now it's okay. I could go for a risk-free rate of return of 1.5%, or I can take on a little bit more risk and invest it in Apple and I don't know, Bell and Rogers, or I can take on a bit more risk and invest it in smaller companies like small Canadian companies, or a bit more risk and invest it in veterinary hospitals. But I mean, I do think as well, people, with what's happened in the pandemic, veterinary medicine has kind of developed a reputation as less risky because it did shrug off the pandemic pretty nicely, as we saw from revenues over the past year.
Yeah, and that's one of the things that we're finding is the hedge funds and people with obscene amounts of money are looking for things to buy. And to your point, Chris, veterinary medicine has done very, very well. So it is right in the crosshairs. So when we look at I'm going to hide the view here so we can see more of the slide. When we have the different perspectives and value, so we've got the veterinarian who is faced with a $2.4 million purchase. So it went from, so let's assume we've got a veterinarian selling their practice, the $1 million practice, $150,000 net income. They go to sell it for $750,000. A corporation comes along and says, hey, I'll give you $2.14 million for the same practice. They go to the veterinarians who are interested in purchasing the practice and say, hey, I'll love to sell the practice to you, but I have an offer for $2.14 million. So if you can match it, it's yours. So from a veterinarian, they've got $150,000 to pay this off. That's a 14 times multiple. From a veterinarian's perspective, it'll take 14 years to pay off that practice. Like best case scenario, if they really hustled and they grew the practice, they could probably pay it off in 10, but still it's a long time frame for them to pay it off. And then they ask themselves a question, will I be better off buying this practice or should I start a practice on my own? And in most cases, they're going to be better off to start a practice. And if I was advising a veterinarian who said, I've got a chance to buy this practice, but it's 14 times, if they had the option to start up their own practice, I would nudge them in that direction. Now, from a corporation's perspective.
Sorry, Darren, can I ask you one quick question?
Yeah.
Because I know you do that startup. I know you work with people on doing startups. How long, on average, do you find that it takes for them to sort of become cash flow positive on starting up a practice and kind of pay off their debt that they incur on starting it? Right? So, we say it's 14 years here to pay off this practice if they were to buy it. So what's the equivalent for starting one up?
Great question. So the one way of looking at this is you're earning, so you earn your salary as a veterinarian, which is, let's say, an on par with what an associate would earn. So you would earn an associate level income, and then you use the proceeds to pay off the practice. So when I'm working with a veterinarian on a practice startup, the question I want to answer is, at what point will you be better off than you are as an associate? So when will you earn more money than you as a practice owner than you would as an associate? And the startups that I do, my expectation is after 2 years. So going into your third year, you are better off than you would be as an associate. And I think I've hit that mark with every practice I've worked at with. So that is why I would nudge this person who's looking at 10 years of an associate level salary, and then they'd start earning income as an owner, or they'd be better off in, say, 10 or 14 years. That's why I would lean them towards or nudge them towards starting up their own practice.
That makes sense.
There's also a practical question here, which is, if the purchase price is 2.14, for example, could I come up with that amount of money to purchase it? And as you mentioned, I think the banks are still stuck at 5 or maybe 7 times. And I've seen in certain specific instances with certain specific clients, I've certainly never seen above that. So then the question is, can one even raise the money to purchase in it, or is the purchase of the clinic a non-option if that is the price that it's sold for, unless the owner is willing to discount it substantially because of some sort of, say, personal relationship, for example. So, perhaps, unfortunately, what we may be seeing is in some of the larger practices is, associates or one with, associates that would like to own or maybe being priced out of the market. The other disadvantage that perhaps, is the independent veterinarian should be aware of is corporations, especially consolidators, have economies of scale, right? They purchase at lower amounts because of their volume. They negotiate contracts because of their volume, and it's really difficult, even with purchasing through Vet Purchasing Co., for example, for an individual to just match or meet or beat those numbers. So you mentioned, Darren, working really, really hard, and you pay it off in 10 years instead of 14. Well, the corporation, and this is an example only. Again, I'm a lawyer and not an accountant, but the corporation purchasing it and imposing economies of scale may overnight be able to pay it off in 12 years instead of 14 because of those economies of scale, by way of example only.
You're exactly right. So when great segue into the next slide. This shows one of the ways that the corporates can pay more is exactly to that point where we look at economies of scale. So here's this one practice that we talked about that has $1 million in revenue, $150,000 in profit. And those expenses that I've listed there, I've rounded them, but those represent the average expenses for an average companion animal hospital in Ontario. They're rounded, but they're bang on. So when we look at what a corporation can do, exactly to your point, Jordan, with drug and supply, because economies of scale, they get better rebates, not because they have an unfair advantage, but because they've got larger borrowing, and the drug companies have these transparent rebate programs. And so they capitalize on that. So they can save 10% on drug and supply costs. There's huge savings available on lab because of the economies of scale. One of the things that they do is they've got some very creative internal CE, so they can lower their CE costs. Professional dues are lower because they're able to, like, for example, if you have a 10 veterinarian practice and you want to join OVMA, your cost for the 10th veterinarian is significantly less than the first veterinarian. So we have those opportunities at OVMA. You save money on equipment rental, maintenance contracts, centralized advertising. So just those things alone, that can take 7% off the expenses. So a corporation can buy this $1 million veterinary hospital, run it the same way, but having different contracts with the suppliers, save 7%, and their profit goes up to $209,000, up from $150, just because of the economies of scale and the expense savings. So when you look at 5 times value, 5 times to a veterinarian is $750,000. 5 times to a corporation, looking forward, is $1,045,000. So what is 7 times to you, because if the veterinarian was to pay $1,045,000, that's like a 7 times multiple. For the corporation, it's 5 times. So they're paying higher multiples, but when you factor in the savings that the corporation can yield, it's not as difficult for them. So one of the questions I have is, then I'll run through this slide, and then I'd be very interested in your opinions. So is a veterinary hospital untapped value for a corporation, or is it simply a financial hot potato? And there's some people who have speculated that all these consolidators want to do is buy a whole bunch of practices, put a bow on them, and sell it to someone for a higher multiple. So I buy 5 practices under Darren Osborne corporate consolidation. I've got 5 practices that have, say, $20 million in revenue. I've bought those for 15 times. I sell it to a big corporation for 20. So my question is, in the long term, can a corporation afford to pay something like, let's say, 20 times profit? So there's, I've heard talk that in the UK, which I think is quite a bit ahead of us, their values have gone up to 20 times profit. So if we have a veterinary hospital at $1 million, you go through to the bottom line, you've got profit of 150,000, 20 times value of that is $3 million. So that veterinarian would earn $3 million on the sale of their practice. Great for the veterinarian. The return on investment from a corporation running it the exact same way as a veterinarian is 5%, which isn't bad. But because of this economies of scale that I presented in the last slide, once you filter those down, you've got profit of $209,000. So that same $3 million value is yielding a 7% return. So that's all well and good. So everything looks great. However, let's assume that the trends that we've seen in just the last little while with the pressure on non-DVM wages and DVM wages, let's assume that those are going to take hold. So the cost of non-DVM wages goes up 10%. And even with the increased efficiencies that the corporations have, they can keep it at 10%. The cost of DVM wages, let's assume that goes up 30%. We've seen very, very rapid increases in veterinary wages in the last little while. So if that's the case, then the expenses go up to where they're higher than they were for the veterinarian who initially sold this practice for $3 million. So then the profit goes down to $130,000, and then they're earning 4% on their investment. So what are your opinions on the future of these corporations buying practices at 20%? Is there untapped value, or is it a financial hot potato?
I think it's probably somewhere in the middle.
Yeah, I mean, I'm again not an accountant, and you know, I shouldn't sort of cross the line too far, but certainly I do work with a lot of accountants on these transactions, and the ones that do quite a number of them sort of, you know, do think that allegedly last year the corporate was paying around 12 times, and everybody was happy to get 12 times, and now, you know, the floor is 14, 15 times, or that's what is commonly seen. This same accountant has sort of calculated the ceiling for certain consolidators at about an 18 times multiple. And anything above that, they're paying a premium. Now, with that said, I have seen practices go for 20 times. In fact, you know, I've recently assisted with an LOI on that basis. But that's not to say that you'll see that. I mean, you really have to be hitting all of the parameters that they are looking for to either even get 18 or a premium above 18. Now, the parameters which the consolidators are looking for, it's difficult to tell, but things that feedback I've heard are things like, you know, multiple DVM practice with multiple producers, you know, a good location in a city center, a solid revenue stream of profitable, but other things like Google reviews. You know, one of the consolidators in particular, I know one of the lead individuals on their investment team will click during the investment presentation onto the practice's website and look at Google reviews and then question sort of the balance, the team, especially the presenter. This is the Canadian presenter presenting to the US investment team on that DVM. So and on the practice. So it really, there's a number of factors, and to get those higher multiples, again, from just the limited sales I've seen, really you have to check a lot of those boxes. Will this trend continue to get to 20 as the average? Well, again, to quote this same accountant, I don't have a crystal ball, so it's impossible to tell. The general thought is that this is generally a premium, and that we can expect multiples to fall from here. However, nobody has a crystal ball. I certainly don't as a lawyer, and neither do any of the accountants. But I can tell you, again, in pharmacy, 5 to 7 times is the norm. I had a client pay 8 times, and that was, still to this day is quoted as extreme. And now in the veterinary industry, we're seeing 15 or 20. And so is this sustainable? I don't know. But if I were a gambling man, I would expect to see multiples fall, but that is an impossible prediction to make from my perspective. I just think that right now we have especially 2 consolidators that are really racing to swallow up what I generally perceive to be an untapped market. The current number of hospitals that are corporate owned is very small. And I'll tell you, even in the last, say, 3 months, my phone has just been ringing off the hook with individuals looking to sell. And that's not to say that all individuals or not all practice owners are looking to sell to corporate, but a lot of them are, and especially lately. But, I think the individual DVM can still sort of move into purchase, especially on a personal relationship or a specialty practice, or when he or she knows the area or can just service it in a specific way. But I'll tell you, the number of corporate sales, just in terms of the transactions that have crossed my desk, have never been higher.
So you think it's going to go, you think the multiple value is going to go down? Is that what you're saying?
I think so, Darren, but I don't have a crystal ball. I just think it will normalize a little bit, because I've never, to quote another lawyer in the industry, and to quote even some clients, they almost fell off their chair with the numbers being presented. And, I think it's like the Ontario housing market right now. It's just ripe for normalization. But I'm not an accountant and I don't have a crystal ball. But I would think that, maybe a more reasonable multiple may be the future. I don't know, though.
So
Yeah, I think I've told you this story before, Darren, where I was chatting with a guy who's a VP at, I think it's KPMG. And, him and I were chatting about valuations and things like that. And I sort of said, yeah, there are vet hospitals that are now going for 15, 18, 20 times. And he was blown away. Like, this guy does mergers and acquisitions all the time. And he was saying, these are the kind of multiples we see in like frothy speculative tech companies, where they've got just projections of earnings that are, we're going to go from 100 users to 3 million in the span of 6 months type thing, right? He was like, that's the kind of multiples of cash flow that we're seeing for some of these companies. Yeah, so I mean, I would probably line up with Jordan here. I don't have a crystal ball either. But, and we've talked before about, what does higher inflation do to this? Higher inflation that leads to higher interest rates, and higher interest rates that lead to a higher required rate of return on veterinary hospitals. I mean, mathematically, just through the mechanical, process of evaluation of the buildup model, that reduces the multiple, right? That starts to bring that multiple down. And I don't know what inflation is going to do. I think what was the last reading in Canada of CPI, like 3.2 or 3.4%. But there's all the talk about, well, that's transitory and it's going to go back down, and certainly might. But if it doesn't, and the Bank of Canada is forced to increase interest rates, and the 5-10 year Government of Canada bond yield increases, what does that do to multiples? I mean, the simple answer is it brings them down. But I guess, yeah, same thing is I can't predict the future. I guess, looking at this hot potato column here, yeah, I think, non-DVM wages up 10%. I think DVM wages up 30%. I think those are very realistic, and even talking with some of the corporate groups, they'll purchase a practice and immediately everybody gets rolled over to their benefit plan, right? Which adds a cost. Even if the person's salary, like the staff and DVM salaries don't change, that adds a cost. There's a bunch of costs here that we haven't included, right? There's layers of management for these corporate groups, right? There's the practice manager and the regional manager and the provincial manager, and then all the administration at the higher levels in their office building in Toronto or Calgary or wherever they're located. So there are those costs to it. And then I guess my other question is the revenue line item, right? We have revenue staying the same at $1 million, whether it's veterinarian, corporate, or hot potato. But we know the practice owning veterinarian tends to be the most productive veterinarian. So what happens when that person sells to corporate? Well, they're still in the practice, and what happens to revenue when that person leaves the practice? Those are big question marks for me.
So now I've always got a Pollyanna outlook on life, but one of the things I did was I looked at the untapped value of one of my favorite things to talk about is raising your fees. And I still think veterinary fees are low. Still think there's a lot of room, even though OVMA is recommending the largest fee increase we've recommended in a long time because of the expected inflation this year. Even after that, I still think there's an opportunity to raise fees. So if you've got a corporation that has these increased costs to pay and the rate of return goes down to 4%, a 10% increase in professional fees will increase revenue up by $80,000, and that will filter right down to the bottom line, and that pops them right back up to a 7% return on investment. So I think that there is untapped value in veterinary hospital, and I think that this is sustainable if it's run properly, because I think there's an opportunity to increase veterinary fees even higher.
Yeah, Darren, that's a very good question. I mean, this to me is like the Ontario housing market and trying to predict how it's going to go. I remember a decade ago, saying to my now wife that prices couldn't possibly go any higher and we'll just sort of wait it out. And here I go. I've got, just a red face for having made that prediction. So just when we all think we're at the top, it sort of goes higher. It's very difficult to predict, and there's a lot of external factors, as Chris mentioned too. A couple of the other ones, I know one of the consolidators that is very active right now, there are rumors that it may go public. How will that change the public shareholders? How will they demand or will they influence rather the values? That's a question to be seen. What if some of these other consolidators are backed by large funds? What happens if one of those funds pulls out, or if it changes and becomes a larger backing, or there's a sale to another group, as you mentioned, of one of these consolidators? I mean, the market could change in itself. So it is very difficult to predict. I know I hear the anxiety on the phone when I'm speaking with some practice owners just wanting to get and sell, and vis-a-vis and the stress because their financials aren't perfect because COVID in March, April, May 2020 did affect their 12-year rolling EBITDA. And basically the question is, do you sell now or do you sell later? It's really, really hard to tell. I mean, I certainly had no idea we'd be where we are today, but it is very difficult to predict. And I think the point is you need to sell when you're ready.
On selling, Great segue again. So when you sell to corporate, it generally starts with a phone call. And I've talked to a number of people over COVID where they're having a really bad day and they see the letter that was sent to them from corporate and they've been ignoring it for years and they've had the worst day ever. They pick up the phone. So it starts with a phone call and finishes with a check, but there's a lot that goes on in the middle, and the devil's in the details. And that's where we're going to hand this over to Jordan, and Jordan is going to talk about the what happens to a veterinarian from the time they make that initial phone call to the time they get that check from the corporation. So now I'm going to turn it over to you, Jordan.
Yeah, thanks, Darren. So I believe the slides will be available after the presentation. Is that correct, Darren? Should probably be helpful because I think some of the numbers were cut off in the previous slide. So, I'm just going to provide a high-level overview and some of my thoughts. There's a bit more detail than I normally put on, but it is because it is a complicated transaction and process. So, Darren, it all sort of starts with that initial phone call, or the letter, but perhaps it starts in a few different ways for practice owners. And it could be a letter, it could be maybe reaching out to an advisor, it could be reaching out to corporate directly, or there are this concept of sale groups now. I know there's some that are very active in the province, and they are targeting certain veterinarians, and perhaps one of them has reached out, and that sort of sparked the interest. But nevertheless, I think in preparation of the sale, there's a number of things that a practice owner should contemplate, and it's really, are they ready? Are they ready to sell? Where are they at? Often it is, I'm tired of operating the practice. I just like to do what I'm passionate about, and that is, help animals, be it, I guess mostly small animals in this case. But and why are you selling? And then when you sort of think about the why and you discover it's time and that you're ready to sell and you have a good think, then it's really about, how are you going to sell? And the question is, again, I've seen a lot of, I've had a lot of clients approach me because they have been approached by these sale groups. What I often say is, let's approach the consolidators individually. I think if you hire the right professionals, and there's a number of ways, again, you can do it. You can join a sales group, and there are benefits and there are drawbacks. You can hire a broker. There's benefits there as well. Or you can just hire a lawyer or an accountant or transaction advisor. There's some accounting firms that just have groups now that are specifically set up to assist veterinarians with such transactions. The point is that you have to think about who's in your court and get somebody that is that you're comfortable with and have the right team. And in my mind, the right team are just a group of advisors or professionals, what have you, that has experience in doing this. And these are not unsophisticated transactions, to use a double negative. This is, often they say the largest purchase or sale of your life is your home. In this case, it will be your practice. There's no doubt about it. And the transaction is extremely involved, much more so than if you, say, purchased from a previous practice owner, say 10, 20 years ago, or even 5 years ago. It's just selling to corporate. They have tier 1 law firms, tier 1 accounting firms, and they will do a very deep dive and really get into the weeds and leave no stone unturned. Now, in my first, say, corporate consolidator sale a number of years ago, it was a different process in the sense that it was mostly run out of the US. But now often the teams are set up in Canada, and but I think you can still expect a very detailed transaction. So suffice to say, think about who your professional advisors are. if you can find somebody, be it a lawyer, accountant, both, a broker, if that makes you comfortable, that often deals with corporate consolidators, you are way ahead of the game. I can tell you, I've seen it more than once. Calling the right person, asking the right questions with either the top line purchase price, you can gain, significant material value by just knowing, what to ask for, and also knowing what's on there, but most importantly, what's not on there. And when I say on there, I'm referring to a letter of intent. What is a letter of intent? A letter of intent is the roadmap for the transaction. And that's where all these corporate consolidators start with. It is so really, before we get into the letter of intent, and I think my slides are a bit out of order, but what we should do is just talk about preparing yourself in your practice. And I have a number of
for a second. So is a letter of intent an actual letter? Like, is it a letter?
Yeah.
Dear Darren, I want to buy your practice. Check yes.
Yeah.
If you want to, check no if you don't want to.
So Darren, why don't you skip to my next slide and then just come back? And I just want to talk about this for a second, because I think it actually makes sense to speak about it first. And once you've decided mentally that you're ready to sell, I think it's really time that you sort of, especially if you want to minimize transaction costs, you start thinking about and sort of getting your ducks in order, and look at things like, where is your practice, and what condition and what state is your practice in? And when I say that, I'm referring to the corporation, assuming you are incorporated, or if you're running a sole proprietorship, where is your practice? And I can't tell you the number of veterinarian clients that I have that say, I have a very clean practice, and I do a number of transaction searches before a transaction starts. PPSA search, litigation search, bank act, execution, etc. I will do the searches, and I'll tell you, a number of those searches will come back in so many cases with results. And I'll say, well, you said you have a clean practice, but what about these, 3 PPSA searches, these 3 liens that are registered against your professional corporation? Oh, well, that's for a line of credit and I haven't utilized it. Yes, but of course the bank still has a lien. And in order for you to sell this, you've got to have that lien discharged. And if I'll tell you, often, and Darren, you've heard me say this more than once, most of the time in a traditional transaction, I say traditional, not selling to a corporate consolidator, because the transaction is much more involved in other areas. But much of my time is spent sort of assisting with third parties. And that is really, helping to discharge the lien registrations with banks, with, maybe you've got your car on the corporation, and also with your landlord. Have you spoken to your landlord lately? And most importantly, have you looked at your lease, and does it have a change of control provision in it that requires landlord consent before a change of control? And change of control is selling often 50% or more of the shares of a corporation. It can be defined in any way in that lease, but that's often where we see it. So you sell the shares, you have to discharge the liens, you have to notify the landlord. And when I say landlord, I mean on all material contracts, if they have a change of control provision, you need to contact the party and obtain their consent before the transaction happens. Often we see that with leases, because leases are so material to the operation of the clinic, but really it can be any material contract, even a supply agreement. So the more work you can do in the background, the better.
How long would this take? So let's say I want to sell my practice to you. Today's June 1st, and it is a gong show, because I haven't kept my minute book up. I haven't looked at any of this stuff. You find all this stuff. How long is it going to take for you to clean up?
Yeah, good question, Darren. I mean, honestly, the more proactive the practice owner can be, the lower the transaction costs are. I mean, I will put an associate or a student on this because it's really chasing third parties that aren't time sensitive. So again, the landlord, may be on vacation and he or she just may not be very responsive. Cleaning up a minute book is a process that we can control. It's contacting the accountants. Have you declared dividends? Okay, we do what's called a rectification resolution or a whitewash resolution. We clean everything up, especially if the minute book's deficient. That's not a big deal. It's the third parties. It's the banks and it's the landlords. Be proactive, contact them, or just take a look and say, what is there? Or contact a lawyer and say, run a couple searches and let's have a chat. We can, of course, do this during the transaction, but again, I will want to start this as early as possible.
So how long should I allow for this? A couple of months?
Yeah, good question, Darren. I mean, everything varies. Who is your landlord?
I know.
Give me a corporate. Is it small? Honestly, I think the more time, the better. Corporate consolidators often have the letter of intent 3 months out. So, sorry, the transaction closes 3 months from the date the letter of intent is signed, and that is to allow for due diligence, which I'll get to in a second, but also these processes go through the documents, review them. Are there change of control provisions? Do you have liens? Let's start contacting the third parties. This can take significant time. It will hold up a transaction, and it's always very stressful. It can honestly take 2 months.
Okay.
I'm not saying it always does.
But I know, but that's a good answer. Good answer. So, okay. Now the other question I have is, if let's say I've got I'm a great veterinarian, I run a really great shop, but I've just haven't been looking after all this other stuff.
Yeah.
If and you fix it in 2 months, is that going to make me look bad to the purchaser, or do they not care? If it's clean, it's clean.
Yeah, I mean, it will certainly make the transaction less complicated and the process less complicated. I don't think it looks bad, so to speak. I've seen minute books that haven't been touched since 1989. I mean, I've seen it all. And I often run these searches. Any lawyer that practices in this area will just sort of have their checklist and run through it. And it's really between the lawyers. It's not really between the business, and the business won't back away on this basis. I've never heard of that.
So it won't affect my value as long as it can be. It's like your car is dirty. You clean the car up and you present it to a purchaser. They don't care that it was dirty. Now it's clean. So that's all they care about.
Yeah, I mean, even if you've already presented the car, to pick up on your example, one of the conditions of selling the car is that you clean it up.
Okay.
And as long as it's clean, that's all that matters. So Darren, that's the sort of precursor. If you could actually just back up to my letter of intent slide. So the letter of intent, to pick up on your question, is a letter, and really it is a non-binding document. It's non-binding. They're almost always non-binding, and it sets out the business terms with respect to the transaction. It is a roadmap. And certainly in some cases, I have some clients that have letter intent fatigue. When dealing with corporate consolidators, the answer is the lawyer's two favorite words about how complicated these are, and those are it depends. And it really depends on what are your plans after closing. It depends on a few things, sorry. Number one is the quantum of the purchase price. And number two, because the quantum of the purchase price may or may not necessitate or involve, depending on who your advisors are, more complicated tax planning. And when the tax tail wags the dog, pun intended, these letter of intents get much more complicated. And number two, what are your plans after closing? There's two types of letter of intents from my understanding with these corporate consolidators. Number one, do you want to be an employee after closing? Number two, do you want to be an owner after closing? And there's two different precedents, as is my understanding from speaking with the director of business development. one of the consolidators. And, it just gets more complicated from there. But, at the outset, the more of the business terms that we can set out on paper, the easier it is to negotiate later. Because once the lawyers pick up on this, if you don't have it in there, or if it says something contrary to your intentions, it's going to cost a lot more money, especially when there's sophisticated lawyers who are just used to bargaining on this basis. And they're going to say, no, it's in the letter. It's in the letter. It's right there. So let's get everything in there. It may take a bit more time. It's worth it. It's worth having a lawyer, an accountant, and a transaction advisor review the letter of intent.
So how long is this
so
letter
worth
of
it.
intent? This sounds like more than just a one pager.
It is probably about 10 pages, but it depends on how complicated the practice is. Number one, things like, again, are you going to be a part owner after closing? And we can talk about that in a second. Are you just going to be an employee? If you're an employee, who's the managing vet? Is the managing vet going to be incentivized? Is there a lease involved? Are you going to be a landlord? What are the terms of the lease? The more you can get in there, the better. It is well worth it. I have seen clients recently, non-veterinary clients, sign letters of intent and come to me after, and you look at this and you think, I think to myself, how could you possibly have signed this? There's language in here that has you terminating all employees immediately before closing. This is like $200,000 obligation in terms of termination pay and severance. How could you possibly have signed this? This is not a veterinary example, by the way, but it's just, it is well worth getting the advisors on early and having somebody with some knowledge to review these things. So let's talk about a couple of these, a couple of the options that I've spoken about. Number one, with respect to tax planning, I'm not a tax lawyer. I'm not an accountant, as I mentioned, but there's ample opportunity to get some sophisticated tax planning done. First of all, if you're selling shares, you'll want to utilize your lifetime capital gains exemption. But I've also seen the ability to do hybrid transactions depending on the quantum of the purchase price. And that just saves you on tax. First you sell assets, then you sell shares. This is getting very complicated, but the other thing you want to think about is what is going to happen with capital gains rates. A number of the consolidators, if you're considering staying on as a partner, will want you to retain a certain number of shares. Well, if you retain them and say you started the practice 10 years ago, or you bought the practice 25 years ago, the cost base of those shares is going to be minimal. If you retain those shares and capital gains rates go up, again, I don't have a crystal ball, but every accountant and every tax lawyer who I speak to seems to think they will. If those rates go up, then you'll be paying capital gains at those new rates. What we've been doing in certain transactions is having the veterinarian sell 100% and then buy back into the clinic. And that is just, again, there's a million ways to plan this. I'm not the individual that structures this. This is just what we're seeing. But it's consideration to buy back in. Why would you buy back in? You sell, take the hit on the capital, take the capital gain today under the current rate, buy back in at a higher cost base. In the future, your cost base will be much higher. The gain will be much lower. Why would you consider, so let's talk about being an employee versus an owner. So there's two options. So again, often if you are an employee, it's often, it's not always, I don't want to generalize, but it's veterinarians that are, say, close to retirement. If you're an employee, a veterinarian that's close to retirement will often be asked to work for 3 years. Sometimes it could be negotiated to less, but not always. Consolidators don't like that very much because they're buying an annuity. They want a practice that keeps producing. So you'll be an employee, you'll sign up as an associate, standard production. There is, again, if you hire somebody like a broker, an accountant, or a lawyer that does these a lot, We can get some more money on the production side, maybe ask for items that aren't normally included in production, things like prescriptions, which are high margin items from my understanding. And also, who is the managing veterinarian? And the managing veterinarian, every consolidator will want to sort of appoint somebody on the ground. The managing veterinarian can often be eligible for a leadership bonus. What does that bonus look like? If it's not in there, let's get it in there. That's one of those items that, sometimes it's not in there, can be taken out. We can get it put back in, and that'll pay for itself time and time again. Again, if you hire the right professionals, or you decide to use a broker, just somebody that's experienced, a stroke of a pen or an ask can pay for these fees. So it's really, really important. So that's sort of an employee, it's generally production, similar to an associate. You can get some more out of it. What does it look like as being an owner? Well, if you buy back in or you retain, often consolidators like you to retain about 25%. That's the number I see most frequently, or buy in up to 25%. If you retain, for example, it's 25%, then you hold 25% of the shares. You're entitled to dividends on those shares until you sell. As part of the letter of intent, we'll have two things that we insert called a put option and a call option. The put option allows you to sell. You won't be able to utilize that put option until about 3 years, and we'll have the metrics as in terms of what you sell at. A call option allows the consolidator to call the shares. Why would they want to do that? Well, if you commit fraud or get fired for cause, or you lose your license, or something tragic happens, such as death or disability. These are normally items in a shareholders agreement, by the way. They'll want to call the shares. And the question is, at what value? And so often, what I was seeing in the past was certain consolidators would allow you to sell at the corporate value. The corporate value is much higher than the value which the corporation is buying practices at. It's around, right now, my understanding, one of the consolidators is well above 25 times. That has been shut down. What I'm seeing now is a cap at 20 times, but it's really the then fair market value at the time of sale of the balance of your shares, less 2 times, less 3% corporate costs. This is from one of the consolidators' letter of intent. They can all vary, but that's sort of what we're seeing is a cap of 20 times. So say the clinic, again, you're retaining shares. You sell today at 15 for example purposes only. In the future, if, Darren, your prediction's correct, the consolidator is buying at 20, perfect. Then you sell at 20. If they're buying at 22, again, it's capped at 20. You take advantage of that higher delta. The benefit is the economies of scale, Darren, as you mentioned. So suddenly those earnings are higher because corporate has come in, and then suddenly, they have imposed, they've shared their purchase discounts with the practice. They've made things more efficient. The earnings are higher. So all of a sudden your dividends are higher, and the EBITDA, the acronym for which I believe is earnings before depreciation, amortization, and EBITDA.
Interest
Earnings
and
before
taxes.
Yes, thank you, Chris. Basically, that is suddenly higher. So, that is just a way. It's called the joint venture program. It's a way for retention. As I mentioned, depending on the planners, what we're often doing now is having veterinarians sell and then buy back in under the associate program. Some consolidators allow for it. It seemed to be pretty novel. Why would you want to do that? Well, again, it's the assumption that capital gains rates will go up. This is an assumption, nobody knows for sure, but it's sort of a common thought in the with the tax bar. So you take the capital gain today, you buy back in. What some consolidators will do, again, this is pretty cutting edge stuff, is they'll allow you to buy back in at a lower multiple. So you sell at 15 times, maybe you buy back in at 12 times. So you buy back in at a lower value. All of a sudden, you've then parked some money. If you're a minority shareholder, I've even seen consolidators extend their loan program to you, which is an internal loan that they will lend to you. It doesn't go on your credit, to buy back in. Interest generally, from what I've seen, is around 6% or higher. The interest rate is high, but again, it's sort of this special loan. So the sky's the limit in terms of structuring. There's a ton of options. It depends on the value and it depends on your life choices. That's why a good think about this and the right advisors, they can create a world of difference. They really can.
I thought that the letter of intent was simply a really simple letter saying, I want to buy your practice. And then you started entering into negotiations. But from what you're saying, the letter of intent is almost like the draft of the sale agreement. This is what we want. And then you draft the sale agreement from the letter of intent.
Yeah.
Is that?
Yeah.
Okay.
Yeah. It is a detailed document. The more detailed from my perspective, the better. Because again, as soon as the lawyers, especially for the corporate consolidators, get a hold of it, and if it's silent on something, or it says something that is in the inverse, such as my example from the non-veterinary world of terminate all employees immediately before closing, negotiating against that is 10 times the cost. And you may not get there because they may point to it and say, you agreed to it in here. Really, really important to be detailed, even though it might be a drag, but also to have your advisors look at it prior to signing it. It is much more than a letter that says we're going to buy your practice. It is the roadmap for the transaction.
Okay.
And it's tough, Darren. I mean, sometimes, we'll get we'll get the advisors in there and I'll get involved, for example, but the vendor won't have hired, say, the transaction advisor or found an accountant that's experienced in this. So then they've got to go and retain them. And then it sort of becomes a long process. It's really important to do this right.
It's a lot more involving than I thought it was. I thought that this was at the end of the process, but it sounds like it's at the beginning of the process.
Yeah, typically when I'll get involved, the best case scenario is you'll have your offer with each company. They'll sort of have the offer presentation, and then they'll send you a draft of the letter of intent, and that's when I'll sort of roll my sleeves up. That's the best case scenario.
Next slide.
Yep. 2 slides up, actually. Yeah, so letter of intent's been signed. You've got your advisors. Due diligence, I mentioned this before. This is where they go through all documents. So again, transaction preparation, be ready with your files in your agreements. Be ready to pull everything out. 3 years worth of financial statements, all material contracts, employment contracts if you have them, your minute book, time to locate this stuff, send it over, hire, any good lawyer should be, or accountant, probably the lawyer should be able to help you to upload this into an electronic data room. And beyond that, should, depending on how involved you want them to be, should be able to review these documents for things like change of control provisions, which, as I mentioned, you'll have to say in a representation and warranty, the documents, especially the material contracts, are in good standing. So you may want a lawyer to review them. At minimum, you may just want assistance uploading them into a data room, or maybe you'll do this yourself, but it's really, really important that you go through your files and get your ducks in order, because these will become very important documents. So we've done our due diligence, everything's been uploaded. So then maybe we're not there yet. Then the purchase agreement. So the purchase agreement plays a very large amount, or borrows a large amount of the business terms from the letter of intent. So again, we'll set it up as, and often the purchaser, being the corporate consolidator, will want it on their paper. So again, this, I've assumed a simple transaction here. I've assumed that you're not utilizing the hybrid structure, which when a US consolidator purchases from you, depending on the value of your clinic, you can do a hybrid transaction and again, sell goodwill. And there's certain elections that you can perform. It's my understanding that it saves you a bunch of tax. Again, this is assuming you're selling shares. So, and this will be the vast majority of most transactions. So whether you're selling 100% of your shares or retaining 25%, the purchase agreement looks mostly the same. You set up the parties. What is the purchase price? How is it going to be paid? So payment, from my perspective, it's really important, cash on close. Some of the US consolidators were paying over a period of time. I just asked for cash on close. Cash is king. Certain other consolidators like to insert what's called an earnout provision. And an earnout provision is if you hit certain thresholds after closing, you will be entitled to a bonus. Often it's a year out. And if you hit, say, a certain revenue target, you'll be entitled to, say, another $100,000, for example. That's an example only. Certain consolidators like to use it more than others, but that's essentially what an earnout is. There's also holdbacks, which is not mentioned on this slide, but often certain consolidators will hold back $50,000 to $100,000 just in case there are any issues with working capital or with a breach of the reps and warranties, which I'll talk about in a second. Working capital is the second major number in a purchase agreement. Everyone's always focused on what is the value of shares, but there's two numbers that you need to negotiate in a share purchase transaction. The purchase price of the shares, working capital. And when I say working capital, I mean, what is the working capital target? What is working capital? It is a purely accounting concept. I'll leave it to your accountant to explain it to you further, but basically, simply put, it is current assets minus current liabilities. There will be a target. Traditionally, it was the value of inventory, but I've seen corporate really set it at anything from 0, which means they'll pay for inventory, any working capital in, to other corporate consolidators take a very US type approach to it, where they only buy assets in the US, they don't buy shares, and they take the US approach and they say, we want all your assets and no liabilities. And it was very confusing with this particular consolidator a year ago when they didn't have their Canadian office up and running, because how do you estimate all liabilities to the moment of closing? How do you estimate HST payable to the moment of closing? It's very difficult. But now we've got it down to a science. They still ask for all assets. Things you should be aware of when they ask for all assets in the corporation, even assets prior to the date of sale, you want to pull out cash and cash equivalents. It is assumed that you will be able to strip the corporation of cash or cash equivalents up to a certain level, and that is the working capital target. And beyond that, accounts receivable. Certain practices I see have material amounts of accounts receivable. If you or your lawyer are asleep at the wheel, the corporate consolidator will take advantage of the accounts receivable. This can be worth $100,000. You need to make sure it's addressed in the letter of intent and you pull it out. The corporate consolidator, I've seen things like the corporate consolidator on a recent transaction I did, has the ability to collect and owes it to you as part of the working capital true-up, or it's up to you to collect and they're assigned to you after closing. The sky's the limit, but think about things like that. Do you want to leave all assets in? How are you going to pay all liabilities? This is important stuff. Traditionally, working capital is set at a target. Traditionally, it's inventory. $20,000 comes to mind. The number I've commonly seen, this is always set by the accountants. The lawyers just draft around this. You'll always set a target. 3 months after, the accountants will get all the numbers. They'll do the statements, and then they'll see how close you were to the target. If you left too much money in the company because, say the target is 20,000 by example purposes only, and you left 25,000 in, the purchaser owes you a check for $5,000. Vice versa, you didn't leave enough in, you left, say 15,000 in, the target is 20, you owe the purchaser $5,000. There's a true up, generally speaking, 3 months after. Just keep that in mind.
So with respect to inventory, what would happen if you, let's use that $20,000 estimate, and the person who was selling the practice, they ran the shelves dry. So would that mean that they would owe the purchaser $20,000 because they're expecting $20,000 worth of inventory? So on the flip side, if I accidentally made a huge purchase and bought all my parasite treatment for the year, and I had $50,000 worth of inventory, then the purchaser would owe me a check for $30,000. The difference between that $20,000 estimate and what's there. But so that would all get settled.
Yeah, because inventory, to Jordan's point, it's current assets minus current liabilities. Inventory is going to be a huge component of your current assets. So if you stack your inventory, your current assets go up and your net working capital surges above the normalized rate.
Okay.
Yeah, a few things. I've seen everything under the sun. I just closed a transaction where working capital had to be $80,000 in cash in the bank account. That was not in the veterinary world, but that is an example of where we get very granular. Often I've seen the corporate consolidators set working capital at zero, which means they'll pay you for inventory. Other consolidators, as I mentioned, expect all the assets to be in there and no liabilities. And that's that. So you really want to hone in on this with your accountant. First of all, what is the concept? Have your accountant explain this to you. A lawyer's not the right person to do this. And then beyond that, what should the letter of intent say with respect to the target? And just make sure the letter of intent, similar to accounts receivable, reflects that. Because if it doesn't, then you're just leaving cash on the table. So it's just something to be aware of. And then, just making sure there's a clear understanding of that. So just sort of moving on, Darren, reps and warranties, that's in a purchase agreement, this is really important. Reps and warranties are what the purchaser sues on after closing. So a rep and warranty, there's a laundry list. Often there's many pages of this stuff. It is like, there is no litigation in the practice, but that actually matches up with disclosure schedules. So disclosure schedules are something that the vendor prepares to say, okay, in the due diligence, I have disclosed X. So in my litigation example, there is a lawsuit on the books. There are no lawsuits except as listed in the disclosure schedules. The disclosure schedules are something that the vendor completes, and they line up with the representations and warranties in the purchase agreement. So the purchaser has one single document in the history books that will say, this is the clinic at a piece in time. This is the clinic as of the closing date. And I get clients say to me all the time, Jordan, why do I have to do this? I just gave them all these documents, satisfy themselves. And this is really how the transaction goes. It is representations and warranties. I have no litigation except for this. I owe no taxes except for these. Or frankly, I owe no taxes. And then if there are exceptions, it's up to the vendor to list them in schedules that are attached to the purchase agreement. So again, I owe no taxes. I have no litigation. I have no employees. These are my benefit plans. It covers everything in the clinic. So that is something you really want to go through with your lawyer and go through with a fine-tooth comb and make sure you list everything and take the time. And then the question is survival. How long do those reps and warranties survive for? Because if there's a problem with the clinic after closing, the purchaser is going to come back and say, no, in the purchase agreement says you had no taxes payable for a pre-closing period. And guess what you do? So you're going to pay some taxes. Generally speaking, they survive for 2 years. You should be looking for about 18 months. That is the current deal etiquette, I guess, in the Ontario market. But also what you can do is insert what's called a cap and bucket concept. So the purchaser can't come back to you until a specific cap, say 100% of the purchase price, for example. Sorry, the purchaser cannot sue beyond that. Obviously, you don't want them to take more than the purchase price from you. A bucket concept means it's a tipping bucket concept, means they won't bother you until the threshold of the tipping bucket. If that threshold is $10,000, they're not coming back to you with every little issue that's say $100 until they add up to 10,000, and then tipping bucket, you owe them from the first dollar. That's how the purchaser will come back and make your life miserable after closing if you don't pay attention to the reps and the disclosure schedules.
I'm still not clear on this. Give me a specific example of what they would come back for.
Yeah, good question. So a current transaction on my desk, this one is pharmacy. There was an audit by the CRA for the pre-closing period. It is currently going on now. And the vendors ran a whole bunch of stuff. They were very aggressive in their planning. They had a very aggressive goodwill declaration in some of their filings. They ran their golf dues through the corporation. They ran all these car expenses. And the CRA has disallowed $586,000. And my clients now own the pharmacies and now have to go back to the vendors and say, no, sorry, you were very aggressive here. We are claiming against you for this, including costs of professional fees, both accountants and lawyers in responding to the audit. That's on my desk right now. So an indemnity is you will indemnify, you will hold the purchaser harmless against the things in the reps and warranties. We've discussed this now at length. I just want to touch on the restrictive covenants. Restrictive covenants are things like non-competition, non-solicitation. Non-competition, there's three things that you can negotiate on. It's the term, the radius, and the type of business. We all know the type of business. It's really the term or the radius. They have to be they have to be reasonable in order to be enforceable. It's a bit of a it's often a point I struggle with as to whether to negotiate them. I will only negotiate them if it's very important to my client who is the vendor, because if you negotiate them too hard, it can give, or too much, or you can easily give the purchaser the wrong idea about your intentions post-closing. And again, the purchaser in this case is a corporate consolidator. They're buying an annuity. They want to know that you're in there producing and the value of the practice will remain the same and that you won't go across the street and open your own clinic.
Now, just to be clear for people who are listening to this, there's non-competition agreements, in your opinion, are not, the court will not uphold those if it's a staff veterinarian and the staff veterinarian signs a non-competition agreement, leaves the practice, and then the practice tries to sue them for non-competition. The courts have found that that's not, it's against your civil liberties, so those just don't fly anymore. But if you're selling a practice, the court does uphold a non-competition agreement because that's part of the deal, right?
Yeah. The Supreme Court in their 2013 case was very clear on this, and it delineates two types of non-competition agreement. Number one, a non-competition agreement in an employment context which generally speaking is not enforceable. Now, a well-drafted non-solicitation restrictive covenant in an employment context, i.e. you won't solicit my customers, my clients, and my employees, is enforceable in an employment context. In a sale of a business context, the court differentiated this and said it is not in the best interest of purchasers paying full value for the shares of your company to have you cross the street and compete. So your non-competition restrictive covenant is enforceable in this context. You can expect to see, especially if you sign on as an employee after closing, one covenant in your purchase agreement or in a separate document, and a second covenant in your employment context. They will have two. They often mirror each other, but you can bet dollars for donuts that that non-competition covenant is enforceable in this context. I generally don't like to negotiate them unless there's a specific need.
Okay. And do you want to touch on the non-disparagement?
You just won't speak poorly.
Okay.
That's not in about the practice. That's not in, I don't see that very often.
Yeah. So what implications does this have if I call up a veterinarian who sold to corporate and I said, hey, how did things go? They've signed a non-disparaging contract. So
yeah, I mean, it depends what the contract says. Generally, again, I don't see these very often, but it just says you won't speak very poorly of the practice. And it's things like slander and, it's just generally be careful and speak factually. And again, it depends what the covenant says, but don't speak poorly of the practice and sort of badmouth them. I don't see these in a lot of agreements. I put it in there just to mention it.
Okay.
Yeah, so again, this is just an overview of the transaction. We've gone through most of this at this stage. Clean up your minute book. Start dealing with any lien registrations against your professional corporation or against you as a sole proprietor. Get those consents on material contracts, especially the landlord. Contact them as soon as possible. And then, the balance of the transaction, it doesn't stop at the share purchase agreement. There's a share transfer. There's other documents. There's ancillary documents. So that is how you sell your practice. Now, the question is, are you going to retain ownership or are you going to buy back in? If you buy back in, that is a separate and distinct transaction. So there's two transactions. Okay, they'll occur close in time, but there are two transactions. So keep that in mind from a cost perspective. You need to weigh the cost of maybe saving on tax, at least if you think capital gains rates will go up, with the fact that you are doing two transactions. The other thing is when you retain ownership or you buy back in, you'll have to negotiate a shareholders agreement as well. Those are lengthy documents. They take time. The provisions are pretty standard, but they do take a lot of time to read through, and just keep that in mind. So it is actually a second transaction if you're looking to buy back in. And if you want to do the full gamut, as your practice is worth a lot and you've hired the right tax advisor, you're doing the hybrid and you're doing the buyback in, that is 3 transactions. So keep that in mind when you're budgeting for professional fees. These are very expensive transactions because you're dealing with very sophisticated parties. And so just a final couple of words. Again, I spoke about the JV model, the joint venture model. That is, do you want to own together? Compliance with the CVO. Interestingly, in a number of these cases, you're actually going to have to deprofessionalize your professional corporation. And because we have to get around the regulations about just ownership of practices. I won't get into it too much. It's a bit complicated, but you just want to make sure that, again, you're sort of following the rules of the CVO, you update them, etc. And you sort of hire somebody that knows how to sort of go through the motions with respect to the deprofessionalization of the professional corporation, and sometimes even an assignment of assets. It is much more complicated than just selling to another DVM. Often assets have to leave your professional corporation, go to a professional corporation that is run by the corporate consolidator. And then the former professional corporation that you operated your practice under will just be, Veterinary Clinic Inc. instead of Veterinary Clinic PC. And that will hold the non-medical assets. The structuring is more complicated, but again, suffice to say, these transactions are more complicated than your run-of-the-mill sell to another associate or sell to another practice owner. So just keep that in mind, both in the professionals you hire and in your budgeting. And again, post-closing, we talked about adjustments, we talked about the holdbacks. I have not gone into selling your real property. I've not gone into lease terms. I recommend that you retain a commercial real estate agent with respect to either negotiating lease terms or looking at fair terms in the area, or even with respect to the sale of your building. Just another advisor to have on your side. Well, that's about it. So again, plan accordingly, hire your professional advisors, think about tax. It often drives the structure. Get the right lawyers and accountants in place. Get your due diligence, pull those contracts out, push them across the line, hire the lawyer for the letter of intent, have your accountant look at the letter of intent, expect some time to negotiate, and these transactions again can be very complicated, especially if you're doing three. Again, with a hybrid model with the repurchase, they're very sophisticated. So just keep that in mind. Your life will be all consuming for a period of time. You'll be trying to practice veterinary medicine and you'll be on the phone with me. So it'll be very busy, but there is a light at the end of the tunnel. And Darren, to pick up on your slides, it does come with a nice check. So there you go.
And this really speaks to the importance of, like, you didn't even get into too much detail, but there is so much more to this than I think anybody ever expected. And I think this speaks to the critical importance of having somebody who knows what they're doing. Like, I recall you shared a story with me where somebody had their corporation set up, and the joker who set it up, they had one share. So it was impossible to divide that. So you had to, there's a ton to it. So you need an accountant who knows what they're doing, clearly a lawyer who knows what they're doing, and then an advisor on top of that to help you negotiate everything. Those are the three key people that you recommend.
I mean, Darren, I'll tell you, with these things, it's not only understanding the sophisticated nature of these transactions, and these are tier one law firms involved, tier one accounting firms. They're very large national, international firms involved. These are complicated transactions, especially if the vendor hires the right tax planner, or if the value's there for sophisticated tax planning. It can become very complicated. Maybe there needs to be a reorganization to get the corporation to purify the corporation so you can utilize your lifetime capital gains exemption to pull money out. How are you going to structure the transaction? Maybe there's post-closing planning. What are you going to do with the money? Financial advisor is the right individual. But most importantly, getting the right individuals that do this, lawyers, accountants, maybe a broker, that do this on an ongoing basis. You know what's in the agreement, you know how to deal with it, but you also know what's not in the agreement. And with the stroke of a pen, I've added hundreds of thousands of dollars of value, maybe, in certain cases, even seven figures. But also, you want to get the employment terms right after, make sure, or the sort of ownership terms, and make sure everybody's happy. You can add so much more value by knowing, hey, they were doing this last year, they're not doing this. Let's ask for it and see if we can get it in there. Or I know that this is the current threshold. We won't sort of push back on that. We'll push back on the rest. Just because I'm dealing with the corporate consolidators and on the phone with them, 10 times a week.
That's awesome. Anybody have any parting words? So we're here for you. If So surround yourself with experts. Lawyer with experience in veterinary transactions. Like Jordan said, you don't know what you don't know. You want an accountant with experience in veterinary transactions and tax. Investment financial planner, because one of the questions is what do you do with your newfound wealth? Is this enough to retire? Because you're getting a big check, but with that big check could be a huge tax bill. So you may or may not be in a position. I would recommend calling a classmate who's gone through this and ask them what would they have done differently. And then of course you can always call OVMA, call Chris, Doherty, and myself for information and advice. And I'll leave you with our emails. If you have any questions, you can email either myself, Chris, or Jordan. And thanks a lot, Jordan. That was an incredible amount of detail. I had no idea that it was that. I knew it was involving, but I had no idea that there was that many loose ends. And Chris Doherty is you've got all your credentials for certified business valuator. Chris just needs the hours, but that's another service that OVMA is offering. Is we're going to be offering a valuation service. So if you have any questions about getting your practice valued, or any of the questions on any of the information that we had today, Chris is a great source for that. Thanks a lot, guys. That was
and Darren, I think, I always say to everyone, I think you and Chris, not only are your services from my perspective underpriced, but you offer incredible value, and maybe beyond a broker and an accountant. I mean, they all have different roles, of course, but you are both great sounding boards and can run the numbers, or at least be a third party or a listening ear to sort of say, yes, this is in the ballpark, or think about this, or and offer an incredible amount of value from my perspective. So I'll tell anybody who listens to call either one of you, because I think you're the OVMA's secret weapon.
I've never heard better parting words.
Yeah, I will take it.
Thanks, guys.
Thank you.
Thanks a lot.
Take care.